A catering company can send a 5-figure invoice for a single Saturday night. 200 guests, a beautiful menu, a full-service team, polished equipment, and perhaps a bar package on top. From the outside, it can look like one event produced a month's worth of profit in a few hours. But the party lasts 5 hours. The business may have worked on it for 5 weeks. Before the first plate reaches a guest, somebody has sold the event, designed the menu, calculated portions, ordered food, scheduled staff, rented equipment, prepared the kitchen, loaded a vehicle, driven to the venue, and solved 100 small problems. After the final toast come clearing, washing, waste, payroll, transport, damaged equipment, and sometimes a client who still owes the last payment. So what does a catering company actually earn? In this video, we will build the economics of a fictional independent caterer from the ground up. The figures are illustrative and shown in US dollars. Real wages, food prices, taxes, permits, and venue practices vary by location. But the financial structure is widely recognizable: irregular revenue, perishable inventory, labor that expands with every event, and a reputation that can take years to build and one evening to damage. A caterer appears to sell food. In reality, food is only one part of the promise. The customer is buying reliability on a date that cannot be repeated. A restaurant can recover from a quiet Tuesday or remake one disappointing plate. A wedding caterer has one chance to serve 200 people at the correct temperature in the correct order, while speeches, photographs, weather, and venue delays change the schedule. The caterer also sells logistics. Food must move safely from a kitchen to a venue. Tables, hot boxes, glassware, linens, serving equipment, and staff must arrive together. The company sells labor coordination: chefs, prep cooks, servers, bartenders, drivers, captains, and cleaners working from the same plan. And it sells reassurance. The client is paying someone else to carry the operational anxiety. That is why the menu price cannot be compared with supermarket ingredients alone. The raw chicken may cost $4 per guest, but the catered plate includes purchasing, preparation, transport, service, equipment, waste, compliance, and the risk of delivering it all at a fixed time. The cheapest version of a catering business can start from a rented commercial kitchen with a focused menu and drop-off service. A full-service event caterer needs much more infrastructure. Imagine a company leasing a modest commissary kitchen. Deposits, permits, legal work, food safety certification, insurance, and initial professional fees might require $15,000 to $25,000. Kitchen upgrades, refrigeration, prep tables, sinks, shelving, and ventilation can easily add $40,000 to $100,000, depending on what the space already contains. Cooking equipment, knives, containers, hot boxes, service pieces, smallwares, and dishwashing equipment may cost another $30,000 to $60,000. A used refrigerated van or delivery vehicle can add $25,000 to $50,000. Office systems, uniforms, a website, photography, and launch marketing might need $10,000 to $20,000. Then comes working capital. Food suppliers, landlords, and employees may need payment before clients settle their final invoices. The business needs a reserve for wages, rent, deposits on rentals, fuel, repairs, and the first slow season. A realistic full-service launch can therefore require $150,000 to $300,000, although a narrow drop-off model can begin for far less. Starting smaller reduces capital risk, but it also limits the size and type of events the company can accept. The owner is choosing not only equipment, but a business model. Catering revenue is usually constructed from several layers. The first is the food price per person. A corporate lunch might be $25 per guest. A staffed wedding menu might be $75, $100, or considerably more. Then come beverages, staffing charges, delivery, equipment rentals, service fees, and premium additions such as late-night snacks, upgraded desserts, specialty stations, or event coordination. Minimum charges matter because every event creates setup costs. A 10-person order still requires a sales conversation, purchasing, preparation, packaging, delivery, and administration. Without a minimum, small jobs can consume the same coordination time as profitable ones. Deposits also shape the economics. A typical contract might require a booking payment, another payment before the event, and a final balance by the event date. The exact schedule varies, but the principle is important. The caterer should not finance a private celebration with its own working capital. Revenue is also seasonal. Weddings cluster around popular months and weekends. Corporate orders weaken during holidays or economic slowdowns. A calendar packed in June does not pay January's rent unless the company preserves cash. The sales process has a cost of its own. A wedding proposal may require calls, menu revisions, a tasting, venue questions, and several versions of the quote before the client signs. If the company wins only one of every 4 detailed proposals, the successful booking must help pay for the other 3. Good qualification matters. Before investing hours in a custom menu, the salesperson should understand the date, location, guest count, budget, service style, and decision process. This is also why clear packages are powerful. They give clients an understandable starting point while protecting the caterer from rebuilding every quote from zero. Customization can remain available, but it should be priced as additional complexity rather than quietly absorbed. Let us model one full-service event for 200 guests. The food package is priced at $60 per person, creating $12,000 of food revenue. Staffing, rentals, delivery, and service charges add $6,000. Total event revenue is $18,000. Ingredients cost $3,600, or 30% of the food revenue. Direct kitchen and service labor costs $4,500. Rental equipment, linens, and tableware cost $2,000. Transport, fuel, ice, packaging, and disposables cost $900. Merchant fees, event-specific insurance, and miscellaneous direct costs add $500. The event therefore produces $6,500 after direct costs. That is the contribution toward the company's monthly overhead and profit. It is not the final profit from the event. Allocate a share of kitchen rent, salaried management, sales time, accounting, software, insurance, equipment depreciation, marketing, and maintenance. If this event carries $3,800 of overhead, operating profit is $2,700, or 15% of revenue. That is a solid event, but the margin can disappear quickly. If guest count rises without a signed change order, overtime runs late, rental items are missing, or expensive ingredients are overportioned, a profitable booking can move toward break-even in a single evening. Food cost is controlled long before anyone begins cooking. Every recipe should have a documented yield and cost. If a tray uses 12 kilograms of ingredients but produces only 80 usable portions, pricing it as 100 portions creates an invisible loss. Trimming, cooking shrinkage, spoilage, and staff meals all affect the real yield. Portion control is not about making plates look stingy. It is about designing a menu that feels generous while remaining predictable. Serving utensils, plating guides, batch sizes, and experienced supervisors keep 200 portions consistent. Waste has several forms. There is production waste from overpreparation, plate waste returned by guests, spoilage from poor storage, and emergency purchasing when the team orders too little. Some leftovers can be handled safely according to local rules. Much of the cost cannot be recovered. Suppose a business spends $30,000 on food in a month. Reducing avoidable waste from 8% to 5% saves $900. That improvement can be worth more than booking another small event, because it requires no additional sales commission, delivery, or labor. Menu engineering helps. Ingredients should overlap across dishes without making the menu repetitive. Seasonal products can improve quality and cost. Premium items should be priced explicitly. A beautiful menu is also an inventory system in disguise. Catering is a labor scheduling business as much as a food business. The company needs enough people to execute a large event, but it cannot keep every possible server and cook on a full-time payroll. Many caterers combine a small permanent team with a reliable pool of part-time or event staff. That creates flexibility, but also training and availability problems. Direct labor begins before the event and ends after it. A server scheduled for 6 hours of guest service may also spend time loading, traveling, setting up, breaking down, and returning equipment. A 5-hour party can create a 10-hour paid shift. Overtime is especially dangerous because events often run late. If the contract assumes service ends at 11 but the client extends the party, labor expense continues immediately. Contracts need clear overtime rates and authorization procedures. Productivity can be measured. The owner can track revenue per labor hour, guests served per kitchen hour, setup time by event type, and actual hours against the staffing plan. The goal is not to rush people. It is to identify menus, venues, and service styles that consume more labor than the price reflects. Strong captains and kitchen leaders are valuable because coordination prevents expensive mistakes. One experienced supervisor can reduce waste, overtime, breakage, and client complaints across an entire event. Recruitment and retention deserve attention too. Event work happens at nights, weekends, and holidays, exactly when employees may prefer to be elsewhere. A company that pays reliably, publishes schedules early, provides clear instructions, and treats temporary staff with respect becomes easier to staff. That reliability has financial value. The alternative is paying emergency rates for unfamiliar workers' hours before an important event. A catering company can be fully booked and still use its assets poorly. Saturday evening is scarce. The kitchen, vans, managers, and best staff may support only one large wedding at that time. Once that slot is sold, additional demand cannot be accepted without adding capacity. Tuesday afternoon may sit almost empty, even though rent and equipment payments continue. This creates two kinds of capacity: physical capacity in the kitchen and calendar capacity at desirable times. Growth is not simply selling more events. The company must fill underused periods or expand the system without reducing quality. Recurring corporate lunches are attractive because they use weekdays. School meals, production catering, office meetings, and drop-off orders can create predictable volume between weekend events. Seasonal packages can fill holiday periods. Venue partnerships can send qualified leads and reduce selling time. But volume can become dangerous when too many events overlap. A company may accept 3 bookings that each look profitable on paper, then discover they all need the same van, supervisor, oven space, or service equipment. Capacity planning must happen before contracts are signed. Now consider the business as a whole. Suppose monthly fixed and semi-fixed overhead is $42,000. This includes kitchen rent, salaried staff, office payroll, insurance, vehicles, software, marketing, maintenance, and the owner's market rate salary. After ingredients, hourly event labor, rentals, card fees, delivery costs, and other direct expenses, the company earns an average contribution margin of 35%. Break-even revenue is therefore about $120,000 per month. At $100,000 of revenue, the company contributes $35,000 toward $42,000 of overhead and loses $7,000. At $140,000, it contributes $49,000 and earns $7,000 before tax. But averages conceal the event mix. $140,000 of labor-heavy custom weddings may be less profitable than the same revenue from efficient drop-off orders and recurring corporate work. The owner must know contribution by event type, not just total sales. And the owner's salary belongs in overhead. If profit exists only because the owner sells, plans, shops, cooks, manages events, and answers calls without market rate pay, the business is borrowing from the owner's life. Profit does not protect a company that runs out of cash. Catering has a useful advantage. Clients often pay deposits before the work is completed, but deposits create an obligation. Money collected for an event 6 months away cannot safely be treated as today's profit. Some of it will eventually purchase food, labor, rentals, and transport for that event. A disciplined company tracks deposits separately, forecasts cash by event date, and avoids using future event money to cover old losses. It also negotiates supplier terms that match the payment schedule where possible. Contracts protect both cash and expectations. They define guest count deadlines, menu substitutions, venue access, overtime, cancellation terms, service charges, gratuities, damage, weather plans, and when final payment is due. Every vague promise can become an unpriced cost. Corporate customers may pay 30 days after invoicing, creating a different cash flow problem. Recurring work is valuable, but the caterer must finance payroll and ingredients while waiting. Credit limits and prompt invoicing matter. Food businesses carry risks that cannot be solved with a spreadsheet alone. Food safety comes first. Temperature control, allergen procedures, sanitation, staff training, traceability, and local regulations are operating requirements, not optional paperwork. One serious incident can harm guests and end the company. There is also event risk. Vehicles break down. Refrigeration fails. Weather changes. A venue loses power. Staff members call in sick. The company needs checklists, backup equipment, emergency contacts, and decision-makers who stay calm. Reputation amplifies both success and failure. A delighted wedding client may recommend the caterer for years. A badly handled complaint can spread just as quickly. The best companies budget for service recovery and communicate early when something changes. Insurance helps manage the risks that remain. General liability, commercial vehicle coverage, workers' compensation, property coverage, and policies appropriate to alcohol service may all be relevant. Insurance does not replace safe systems, but it can prevent one accident from becoming a financial catastrophe. Contract requirements should be checked before an event, especially when venues request certificates or additional coverage. Growth should focus on profitable repetition. Standard packages reduce quoting time and purchasing complexity. Preferred venue relationships improve logistics. Corporate contracts smooth the calendar. Thoughtful upsells, beverages, desserts, rentals, staffing, or coordination raise revenue while solving real client needs. The owner should watch sales conversion, average revenue per event, contribution margin by event type, food cost percentage, labor hours, waste, overtime, repeat bookings, deposits held, accounts receivable, complaints, and cash on hand. So, is owning a catering company a good business? It can be. The attractive version combines hospitality with operational discipline. It sells a repeatable experience, prices every layer of work, collects cash before committing major costs, and builds a calendar that uses the kitchen throughout the week. The unattractive version underprices custom menus, treats deposits as profit, hires at the last minute, ignores unpaid owner labor, and says yes to events that the kitchen cannot execute together. Before launching, an owner should choose a narrow starting model, cost every recipe, understand local licensing, test realistic labor hours, build a 12-month cash forecast, and maintain enough reserves for cancellations and slow seasons. They should know exactly which customer they serve better than the alternatives. Because catering is not simply cooking at scale. It is a promise that hundreds of moving parts will arrive at one place, on one date, and feel effortless to the guest. The invoice may be large. The event may be beautiful. But the real business lives behind the kitchen door, in the portions, schedules, contracts, cash flow, and systems that make the celebration possible.